Hello, Howard. It's good to have Mr. Madanagopal Ramu on board for the PMS Bazaar special interview, who's the fund manager and head of 𝐸𝐞𝐜 Sundaram Alternates. So welcome you, sir.
Hi, Akshara.
So one thing what I've noticed about your career, as you started your career as an analyst from Centrum Broking to fund manager at Sundaram Alternates. So you carry a 15 plus strong years of experience. So if you could just about that, what are the hardships you have faced or what are the journey you have come across? So it'll be very useful for analysts like us to grow.
Sure. Yeah, I think it's been a great journey of moving from an analyst to a fund manager over the last, say, 14, 15 years. Post my graduation, it was a conscious decision that I want to move to the equity market. So I got an opportunity to work with Centrum Broking at that point of time with a very good team that was there. So obviously, it started with one sector, and then slowly we started building up ideas on other sectors and started covering it. Good thing that happens by being in sell side is you have very less time for you to pick yourself and move up in terms of your thought process on a sector. So you don't really get a lot of time because you have to service fund managers, and fund managers most of the time on top of what is happening in a sector. So you have to add value to them. You need to be on top of what is happening in that sector, plus bring in that analytical time. The advantage that you have as against a fund manager by being an analyst is the extra time that you can spend on working on the numbers and drill down each and every building blocks of growth and cost, everything to a level to which you feel comfortable in discussing that idea with a particular fund manager. So that brings in a lot of clarity of thought, and that also brings in a lot of professionalism in the way you approach your stock selection. So I have approached the work always from that perspective. It was a journey which had, in my opinion, challenges were always there. But I think in the entire period, one thing kept moving was that you continuously learn to analyze stocks and sectors. And I think that always keeps an analyst work much lively, right, over a longer period of time. So I say that this is a profession which pays you for learning, and the learning stops till you are analyst and head of research. The moment you move to the fund management, learning is important, but learning has to make money. So that transition again was a challenging transition. I was lucky, I would say, because that year when I shifted my path from an analyst to a manager, it was a good year for market, and it was a year when the infra stocks which I was managing, the sector that I was covering as an analyst was infrastructure, and the fund I was managing was also infrastructure, and it was a good year for infrastructure. So everything went off well, and then the real challenge started. So the important transition between an analyst to a fund manager is the head of research role, where I spent almost 2 years, 3 years understanding various other sectors and really knew the difference. I would say if there is one learning during my analyst period, by covering infrastructure sector and tracking a lot of companies in which are if you take companies like JPA, GMR, not many of them are very large value creators in the last, say, so many years. The reason is the way they have handled the business, the capital allocation decisions, the way these businesses have been run, low ROC businesses. Potential for growth is high, but some are things are not falling in place. So that entire period helped me to understand how you should be able to look into companies' financials and listen to management and able to understand what is possible, not possible when you are listening to a management. So that was a great phase for me. And today, as I sit and look at various other sectors, the one thing that I take in when I'm evaluating is what are the mistakes that happened in those periods. And generally, the mistakes are these. One is you generally feel what the management says is possible, and most of the time the analysts tend to believe, because managements give very good, most of the managements build a good story around what is going to happen. So you have to be able to think beyond it and say, this is where there are gaps in what management is saying. And particularly true with managements where, or businesses where the balance sheet is stressed. There is always a turnaround on the card, but it seldom happens. So that's where your role as an analyst and role as a research head So it came very handy. And when I moved into fund management, it helped me to avoid all those stocks and create a reasonably very secular growth and companies with very good balance sheet and back the managements which do what they say. They might miss out by 10-15%, but they don't miss out by 50%. We still have examples where it has gone wrong, but I think you will get 90-95% of the time. If you get it right, it's a very big score. Even if you get 75% above, it's a very good score. But that refinement helped, that being an analyst helped us, and particularly tracking the sector, which has gone through a lot of stress in the last so many years in terms of balance sheet. And that was the major reason for the banking NPA cycle. So understanding banking also became easier to differentiate between good versus bad. So this has been the journey. And I would say as an analyst, I learned how not to invest in India. And in the fund management, I made use of that learning in the right way, I would say.
Okay. So you must, like, as an analyst, we need to have a foundation very strong.
You have to spend a lot of time reading. On an average, I think in a day, if you don't read more than 6-7 reports, you don't do justice to the role, in our opinion, at least the initial part of the career, because you don't have enough, you don't get enough luxury of time for you to to take a year to track a particular stock or sector. So hardly we give 2-3 months for an analyst to come at par. We will handle them, but it is also important that the analyst puts in that kind of rigor. An analyst role is an independent role. So it is not it is never to be seen as a subordinate role. It has to be seen, there is a fund manager and there is an analyst. The analyst has all the rights to be independent, and he has to be independent. If he has to be independent, then he is addressing the needs of a fund manager who has already tracked that sector in some way or other. So he has to add something on top of it. So how much learning he has to do quickly for him to contribute something, that's something which will always be challenging for any analyst. So that phase has to be covered very quickly. Otherwise, if you take a year to cover, then you have a long way to go, and you will keep delaying your growth in the organization as well as delaying your growth as a professional also.
I think that was very good advice. I can take it for myself as well. So thank you, sir. Thank you for that. This I would remember lifelong, I must say that. So coming back to the markets, you see there's a lot of pressure on Nifty now. So what according to you is the reason for this downtrend?
So I think a lot of time is being spent today on inflation, interest rate, and Nifty and all this. I would say if the right points and questions for the investors to ask is, inflation is definitely high, but is it going to remain high for next 2 to 3 years time period? Obviously not. It is going to catch up with the base. Already it has catched up with the base, and a lot of the first thing you have to understand is the reason why the inflation is high. The inflation is high last year purely because there was a supply side shock, and it came because of a war. And despite war is still continuing, most of the supply side issues have been addressed. And we are seeing that in the commodity prices fall. Most of the commodity prices are down. China recovery has also started, and it is not reflecting in any big increase in commodity prices. And US shelter prices are still high, and that is hitting on keeping the inflation sticky in US. And I'm talking about US primarily because that sets the stage for monetary easing for even RBI. They can afford to be little deviant, but not very far. So looking at what is happening in US, people are getting carried away every month. If there is an inflation fall, the market is reacting differently. If the inflation is sticky, market is reacting very differently. So the real question is how long this will go. Probably next 6 months, it will happen. In my opinion, in next 3 months, you will start seeing a direction. If not, I will be really surprised, because most of the components of inflation are down. Shelter is one which takes time to come down because it's a second order impact, which will also happen. It is a lag, and that lag can be 2 months, 3 months, depending upon how strong the economy is. And that is where the economy has shown that the labor market is still strong, and therefore the people are afraid that shelter prices can continue to be sticky for some more period. Yeah, probably another 2-3 months. But I think if you take a year's time, I don't think there is a case for assuming that inflation will not be in the lower end of the assumptions that many people are having at this point of time. So there could be a dramatic change in the inflation trajectory also from where we are at this point of time. So all these are not under any of our control, in our opinion. I think that is why we continuously keep reiterating to the investors that the moment you take a 2 to 3 year view, inflation will definitely be in a normal situation. Once you have that framework in your mind, is it the right time to buy the stocks or sell the stocks? That's the question that you have to ask. Today, in the kind of valuation, if I look at today we are discounting FY24, but 6 months to 6 months down the time, I think markets will remain at a consolidation phase or minor drift here and there. But just look at this scenario, then you will understand that the downside is also fairly protected. The 6 months down the line, you will look at FY25 earnings, and FY25 earnings is around 1,100 for Nifty. And even if you are saying market has been trading between 18 to 20 times, even you take a lower end of the market, 18 times, you get a 1 year forward of around closer to a 20,000 index. I'm not giving a guidance on 20,000 index. I'm just putting a mathematics. Now that 1,100, whether it will be 1,000 or 1,050 is also a debate that we can go on. But just look at currently, it is around 1,100, and 18 times if you give, it is around 19,500 to 20,000 levels. It is already at 17,000. The moment it comes down to 16,500, you get a clear 20% upside on the Nifty itself. That 20% upside on the Nifty with 1.5 years left, I think it's a reasonable return that Nifty is giving. So there is a reasonable downside protection for Nifty itself at 16,500. Probably maximum another 5% correction is what I feel. But we don't even look at Nifty for our portfolio because our portfolios have very little overlap with Nifty. Our portfolios have just 25%, in some cases to 30% overlap to the Nifty index. So we completely look at a different set of stocks where, depending upon the growth, we have bought them. And there, I see clearly valuations have come to a very good bargain level. And the moment the investors keep the issues of inflation away, they are obviously getting many of these stocks at a reasonably good bargain today. So if Nifty will go back to whatever levels that we spoke about, there is a reasonable chance some of these companies which have delivered good growth but have not gone anywhere, they have a potential to come back and create good alpha to the investors. Important point to remember here is post-COVID, things have not been great for particularly long-only sort of approach towards investment, because people move from sector to sector depending upon noise and depending upon short-term news flows. That also helped them. But long-only funds who take a particular view on cycle and all was finding it difficult. Growth particularly was questioned during high inflation period. And if inflation will come down in 2 years down the line, next move in the market, I think, will be supported by growth stocks. Because today, most of the growth stocks have seen a reasonable correction in valuations. Like, for example, our major portfolios, 𝐸𝐴 and Voyager, both these portfolios I have seen in the past never trade closer to the benchmark price to earnings ratio at all, primarily because they always have earnings growth much superior than the Nifty. So pre-COVID, our portfolio earnings growth used to be 20% and Nifty's earnings growth used to be 10%. And this is what we used to tell the investors, that when you build a portfolio with a 20% growth companies and you are benchmarked against 10% growth index, there is no reason that in the long term we will not be able to beat the benchmark at all. There will be short-term periods where we might go away. But in the long term, since always market moves in line with the earnings, there is no way that we will underperform. Post-COVID, what we have seen is there is other sectors also which have participated. Now this 10% has become 15%, and our portfolio growth is also 22%. Still, but pre-COVID, our portfolio valuation used to be as high as, even in periods, as high as going to around 28 times, 30 times also. So the portfolio's earnings growth used to be 20%, and the portfolio used to trade at 28 times, 1.5 times sort of a PEG ratio. Today, portfolio earnings growth is 22%, and portfolio is trading at 18 times. It is trading at less than 1 time PEG ratio. PEG ratio is not a great science or mathematics behind it, but I'm just giving you a flavor. And today, our portfolio, despite being higher than Nifty in terms of earnings growth, it is trading at par with Nifty. So that gives us a lot of comfort, and we can say with confidence. And our portfolio, particularly CSOP, is fully growth-oriented portfolio at reasonable price sort of an approach. And we see today growth is available at a value. And if people talk about value, the value is there in private banks. The value is there in some of these consumer companies, consumer discretionary companies, not FMCG companies, and value is there in some of the manufacturing companies. I think that is where we see opportunities coming through, and therefore next leg of move in the market, I think a lot of it will be supported by growth. And importantly, as we go through this phase, the growth is going back to pre-COVID period for the economy, and therefore in pre-COVID period, the growth became scarce. Not every company was able to deliver more than 10% growth. Yes. So the number of companies who can really deliver more than 20% growth was, you can handpick it in a 3-year time period. In a quarter or two, many companies were able to do it. But if you take a 3-year view, not many companies you can with confidence put a 20% plus growth. We are heading to that situation. And when growth becomes scarce, then obviously the growth stocks will get a premium also. Today, that premium is not in the valuation compared to the broader Nifty. And that's why the growth portfolio is trading at par with the Nifty valuations. So any investor who is looking at the next 3 years will do well by getting into growth stocks which are available at a reasonable bargain at this point of time. They can get two benefits. One, they will get the benefit of premium coming back to growth stocks. And second, the earnings growth itself taking care of the returns for you. So that is what we feel that the market is offering today. While on the broader Nifty, I have said you my numbers, but mathematics, but we don't give any particular, we don't work with the statement that Nifty will be here. We don't make that statement. But if I look at the portfolio that we run, we are fairly confident because after a very long period, or I have not seen in the past that our portfolio valuations is at par with Nifty valuation, and the portfolio's growth is obviously 2 times minimum higher than the Nifty earnings growth. So that gives us confidence that if an investor is today looking at it, or existing investors also, what we tell them is, even if you're concerned, just hold on to it because, or if you want, add to it because you are getting many of these growth stocks at a reasonable valuations.
Yes. So you almost answered my next question. I was about to ask you this. I was about to ask you about your strategies, which can be SISOP or SL for Voyager or Rising Stars. They have done much better than the benchmark. So I was about to ask you that what is that secret investment mantra that you follow?
Nothing. It's purely about earnings and try to get the earnings right. See how you make money in the long term for the investors with risk adjusted. There is a lot of ways to make returns when you look at from a 1 year, 2 year perspective. But the moment you look at 10-year perspective, the best way, it's like playing a test match. So here, the persistence is very important. It is not about scoring big runs in 1 or 2 overs. It is about playing sessions. And you have to play and continue to play and continue to play. And there is no stoppage, right? The moment you continue to play, the compounding effect on the investor's money happens. So your portfolio approach also should be in that way. So what works well for a longer period is the point of debate, and not like being a tactical player where what works for the next say 1 year. That is not the approach. So that is why in a period of 5 years we try to outperform almost 70% of the time. That 20% you will always not perform because those periods are periods where the market is looking at a different approach. And post-COVID, given the lot of money that was chasing the equity markets globally, many stocks benefited out of it. Illiquid stocks particularly benefited out of it, and therefore many performers. But just before COVID, if you go and see, it was purely stock pickers market for 3 years, and we created massive alpha in that period of time, and that we have done in the previous cycle also. So if you take a 10 years, I think 70% of the time, 7 to 8 year time period is going to be periods for stock pickers. That 1 or 2 years will definitely be for the broader market. So last year was a period for broader market, and due to high inflation, people avoided any stocks where the valuations are high, or if there's a short-term earnings issue, people did not want to look at all. And that is what has created the value that I mentioned for you. So in the long term, how do you create value? that question is actually very simple. It is not very difficult for anybody to put in. It really is about investing into growth sectors. So you cannot, equity is a growth investment, right? You are here to make money for the investors, and India has still not reached a dividend yield sort of country. So it is still a country where there is a lot of growth companies. And where the growth is coming from, if you break the entire economy and look at which are the components where growth is there. We put it in another way also. India, since independence, has added $3.5 trillion economy right now. And in the next 8 years, we will add another $3.5 trillion on top of it. So you are going to add another India in the next 8-year time period. But this new India will be very different from what was building it so far. So what is the next $3.5 trillion? It is not going to be the same. I think two areas where we will see a considerable change. One, in consumption. The other way to look at the GDP is through the consumption and investment basket. I think in the consumption basket, consumer discretionary, and this has happened across every country after they reach a particular level of per capita income, and you will see that happening in India. The pace at which, or the rigor at which it can happen can differ from country to country, depending upon the growth rate that they do, and depending upon how the economy structures. But it will definitely grow. So consumer discretionary obviously will beat FMCG companies from a growth perspective. And today in the Nifty, a major allocation is there for FMCG and then auto sector. And there is rarely any other consumer discretionary stock that you can play in Nifty, but it is a fast growing space. So how do you really play this? You cannot stick to Nifty, right? You have to go beyond Nifty for this. Second is, if you look at the pharma sector in Nifty, it has been struggling for growth for so many years. It has become a low PE sector and a continuous derating sector. And even today, we don't see any consolidation happening in the pharma space for you to turn positive. Here and there, 1 or 2 years, 1 or 2 stocks can give you return. But broadly, you have to be really lucky to pick them up. So for us, there is no restriction for us to own a pharma sector. So we kept pharma sector completely away and got into sectors like specialty chemicals. Again, specialty chemicals are not in Nifty. It has to be in mid and small cap space. So again, here, by looking beyond the benchmark helped us. And third, you take any commodity companies or utility companies. Growth has been very poor over the last, say, so many years. During COVID period, due to supply shocks, metals did well after so many years. And I think it is beyond us now. And from here, I don't see any great sort of a push for metal inflation index unless China really surprises us. So China recovery has not helped metal prices to come back. So metals per se is a very high investment business and a very low ROC business with a long gestation period to recover your money. And therefore, metals also is not a space that long-term investor, like I said, if you are a test match player, you cannot be really in metal space. You have to have a very tactical view. You have to get in and get out at the point where you want to be. So that is also out of view. Utilities like power sector and telecom, they have benefited for a short-term period due to consolidation and all. But otherwise, we are not going to see. If you ask anybody in the next, say, in the next say 3 to 4 years, what is the kind of growth you can expect in any utility space? I think the volume numbers will be in single digit. Revenue growth assumptions might be probably 10% maximum. You take IT sector, again, you have an issue which forms 15% of the index almost. It is again, people are talking about 78% growth, and people are talking about companies very positive where they can grow by 10%. We don't look at the benchmark and then decide, okay, this company is growing at 8%, this company is growing at 10%. That's not the game. 10% itself is not what we like at all. We want minimum 20% growth in our portfolio. So therefore, these 20% growth stocks, not even 50% of the Nifty as stocks covering that kind of stocks. So if you are investor, if you are a fund manager, you have to go beyond Nifty and look for these growth companies, whether they are in mid and small cap, but keep a reasonable eye on corporate governance and balance sheet quality. The moment you go to mid cap, so then the question could be, so then we should all invest in mid and small cap. But that is, life is not so easy. Life is not so easy also, because mid and small cap, if you take, there is a lot of junk in mid and small cap space. And there are many sectors which are not growing also is there in mid and small cap space. So it is about selecting those growth sectors out of mid and small cap, and then creating a good multi-cap portfolio along with some large caps and mid caps. And that is how I think a real good portfolio can be created, which can play for a longer term for the investors and create wealth to them. Because if you're playing banking, if you take last 1 year, everybody will say mid and small cap banking has beaten large cap banking.
Yes.
The moment you see 5 years, the story is completely different. If you see 10 years, the story is completely different. So in the mid cap today, Nifty, you have PSU banks followed by NBFCs. PSU banks are seeing some turnaround. Okay, we can accept, but the valuations are too steep already. I think from here, it is going to be difficult for them to justify valuations, in my opinion. A lot of things have played to their favor in a very short period of time. All this will start fizzling out in the next 2 years or so. But they will not go back to the period of 2014-15 NPA cycle, starting NPA cycle. Probably they will consolidate, in my opinion. But whether you will make big returns after this is a very difficult question. Obviously, they benefited. People moved from high PE stocks to low PE stocks within banking space, and they also delivered numbers in that period. So it helped them. But beyond that, PSU banks is not. I don't think are investing in technology or investing in branch. That banking is a very difficult business, and you have to be really proactive in identifying profitable pools. That profitable pools, I think not many managements have been able to do it consistently. And we will always stick with banks who have capability to do it and also back it up and do it consistently. And I don't think that PSU banks have reached that stage. So if you leave PSU banks, most of the NBFCs in Nifty mid-cap banking space is something which you will not buy unless you are just buying them for dividend yield. So that played out last year, and a lot of these companies made money to the investors. But you take 10 years, the entire Nifty bank, Nifty mid-cap, the banking allocation is very risky in our opinion. You have to be very selective in that space. But so that's why I say the moment we say that mid and small cap offers you a good growth opportunities, it is not that you can go and put it in the mid-cap index, because the mid-cap index has 25% banking. I can talk the same thing about many other sectors in the Nifty mid-cap also. So it is all about out of 100 Nifty mid-cap, selecting those 10-15 stocks, and from the small cap selecting some 10-15 stocks, and then in the large cap selecting the 10-15 stocks. That is what we see. We don't align towards saying I will only play large cap, I will only play small cap, I will only play mid cap. I think a right portfolio is a mix of all the three, because India's growth is structured in different categories in different phases. And that is the beauty of the India's growth story at this point of time. Every country, when it is in that growth story, will offer this kind of an opportunity. So a fund sticking cap curve is also advisable. An investor sticking to a particular style is also not advisable, because growth will play some period, value will play some period. So the option should be left to the investor, the fund manager, to make those changes to the portfolio. In the short term, if you try to measure, you may not get the right answer. But look at it from a long term, then you will get the real story. And when macros are changing from high inflation to low inflation within a year's time period, investors tend to make shifts from portfolios based on 1 year return. I think nothing can be more disastrous than this for the investors, because they will be chasing return and market cycle will change, and they will be catching the wrong side of both the cycle.
So what do you think the ideal investment horizon? Because when you say about a year, the returns, the investment horizon for a year is not enough. So what do you feel the ideal
investment horizon for an investor? I tell them is come stay with us for long. I don't even want to put a number to this. And people who have crossed 4 years, 5 years with us have stayed for many years. The reason is, see, the equity is about wealth creation. Equity is not about that you want to earn every month and spend, in my opinion. That portion that you want to do, you can keep it in debt or in a dividend yielding stock. But I think beyond that, what you have is to be put in growth. That is where our service is. Our service is not to help an investor to create a dividend yield for him every month or every 6 months. Our service is, you have met all your demand. Now you have excess money, give it to us. This will be taken care from next 10 year, 20 year perspective, and we can create a multiplier impact on that. So that clearly can be done only if you invest in growth companies, but at a reasonable valuation. We don't believe in this logic like growth at any price. That is definitely not going to work, because if there is a stock, it doesn't take more than 2-3 years for most of the investors in the market to identify that stock. So beyond that, then you are playing only for the surprise in the earnings growth. And even that becomes difficult beyond a point. So buying and sitting on a stock for a longer period at a very high valuations, it sometimes can hit you very severely. So you have to buy growth companies, but you have to buy at a reasonable price. Some changes you have to keep making in the portfolios to that extent. So that is our approaches. And but to the same extent, I don't believe in by investing into low quality businesses just because their valuations are cheap. You might do well in a short period, but sustaining that for a longer period is very difficult.
So
you also need help of market here. You need COVID and then subsequent high liquidity for you to perform. Just look at the number of fund managers who are doing well in the last 2 years and how they were faring in 3 years before. You will get your answer. The approach post-COVID has changed completely. And now next 2-3 years, as the liquidity tightens and as the inflation starts coming down, I think the kind of stocks that will do well will completely change.
Okay.
And it will be same as 2022.
Okay. So you strongly believe in growth at reasonable price.
Obviously, because equity is growth and you have to invest in growth companies. You cannot invest in dividend yielding stocks from a long-term perspective. Then I think debt is much better option than dividend yielding stocks.
Okay. So if you said when you were an analyst, so you were strong at infrastructure. So let me take that infrastructure sector now and as financials, because you know what's going on globally, because financials are not doing that great on a global perspective. So if you have to compare these two sectors, keeping infrastructure and financials on a single space. So if you could pick one, what would it be?
You are asking for Indian banking and Indian.
Yes. Let me put it as Indian banking sector and infrastructure as a sector.
So, for example, first of all, let me explain you what is happening globally and why a lot of noise is being created right now on this global stuff which is going on. See, first point to remember is market never reacts sharply. It will react, but it will not react very sharply like the way it reacted for Lehman crisis, again for a similar sort of a risk. Because everybody knows what are the tools in front of central bankers to address such a crisis now. So don't expect a massive correction for the same sort of a risk which will repeat in the history. The risk should come in a different avatar, completely different avatar for market to react very sharply. So today, if you ask me if there will be pain in the banking space and global markets, it can, because they are now taking the liquidity out and interest rates have increased very sharp period. See, when it comes to banking, the speed at which the interest rate increase also matters. If it takes a longer period, it is easier to pass through. If it takes a very short period, then it is also going to impact the earnings in a different way for different participants in the financial space. And it catches a lot of people who who don't take care of risk. And financials is a very risk. It's a business of risk, right? Risk management. So in that business, if people who have not paid attention to various risks in the balance sheet, I think those surprises will keep coming, and it can create this fear of run on the bank and all this noise. But let me tell you, that will be short term, because I think central bankers today have many tools and they have tried and tested it now almost like 3 times now. So they will know how to address these kind of a situation at this point of time. So if you are seeing market correcting for that reason, it's an opportunity in my opinion. Or there should be something dramatic which is happening, which we are not knowing at this point of time. And that is something which you and me will not be able to envisage. And when it happens, only we'll have to react. And it can be a big blow up somewhere, or it can be it can be coming out from asset class which has been supported by banks underlying. Today, I'm not able to envisage a subprime sort of an issue, subprime mortgage sort of an issue which happened in 2008, because we thought Bitcoin could be a place where a lot of noise can come, but it was also restricted to that space alone, right? Then obviously startup has impacted. Startups stopped getting money now, and that is impacting the startup environment. But I think that is all very restricted to the space that these are. So it's not percolating to the entire banking space. And the banks which had a poor balance sheet structure have always found it difficult. But I think central bankers will step in and address the any risk issues that are there by aligning it back. If it is something to do with the banks and their underwriting capability, then it's a different issue. But as of now, I think markets reacting. Market is also not reacting too fast for all these news, right? Because it has already digested this kind of news in the past, and it will not react in the same way again. So there are enough tools with the central bankers to handle these, is in our opinion. And growth is an issue.
Okay.
Now with banking space and with higher interest rates, and banks will become much more cautious right now to lend in US and all. I think US can go through a much bigger tough time of growth in the next, say, 6 months to 1 year time period. That can hurt countries like India from an export perspective, and which is already showing weakness, right? And
Yes.
India got the benefit during COVID, short-term supply side issues elsewhere helped our companies to supply and benefit out of it. But all those things are going away at this point of time. I think growth is becoming an issue in developed markets, and Europe and US both can go through a very tough time. Therefore, India export story can look difficult, and we are not touching to that extent IT sector at all, and we don't have any exposure at this point of time. I know. I think there is one more leg of negative surprise that is possible. Per se, IT sector, as I told you, is going to grow at 7 to 8%. Will not meet our criteria also. They have to minimum touch 15% or 12 to 15% in our opinion, 12% at least, so that some bit of the dollar benefit can justify and at a reasonable valuation. They should be available at a good valuation also. So that is so banking. Get Indian banks getting impacted because of the global noise around banks. That is a good opportunity for Indian banking space. But let me remind you, next 1 year, the interest rates have spiked very sharply. So the spreads will start contracting. So year-on-year numbers won't look very great. And the way you also saw benefit in the last 2 quarters because of the lag impact of cost of funds. The reverse of it can happen in the next year. So, but there are levers for banks to handle this. They will get, as the interest rate starts coming in on in the last 2 quarters, or probably in FY25 beginning, you will see benefit of treasury coming back. One that can help them to handle it. A lot of banks are having a lot of investment book, more than what is required, so that they can use it to keep the NIM impact lesser. And third, I think a lot of money was spent on digital and all this by most of the banks, so they can afford to be a little more careful about their OPEX, and to that extent they can handle some of this NIM impact in the. And third thing, if they have underwritten well in the last 1 year, I think credit cost may not go back to again big levels. So that also can help them to handle the. So net, I don't see it now. It will differentiate boys versus the men. So good banks and bad banks will get highlighted in the next 1 to 2 year time period. See, banking is an area. I've been telling for a long period. We have not participated in the mid-cap banks rally in the last 6 months, but we are fine with it because banking is a leverage business. It's a business where capital is only 10% of the total that you lend. You are exposed to 100% of your book, but your capital is only 10%. And if you run a low profitable business, that is the most risky exposure that you can throw to the investor. The investors are happy looking at short-term money made in some of these low-quality businesses with low profitability ratios. But when things don't go the way you expect, these are the ones which will take away a lot of your wealth completely, and they will take a long time to come back, in our opinion. Therefore, if you are playing leverage business, play it with the profitable ones, because they will have the capability to handle short-term economic shocks and then move on. So, and they will keep still growing. So that is the reason why we have some filters on. This is the minimum profitability that we want if you are playing a bank. We don't want banks with low profitability and then entering a phase where global slowdown is going to happen, and India's growth also might moderate. So that is the reason. So banking, we are positive, but you need to be very careful on what you play. You cannot have the luxury like last year where you played the risk. the riskiest part of the banking and then made money. I think that you have to be a little careful in the next cycle. On the infrastructure side, I think infrastructure is a great story. Continuous focus on infrastructure investment is good, but opportunities also keep. So what is happening in the spaces? There was a period in 2004 to 2008. India went through a lot of deficit in most of the infrastructure. If you take power, we had deficit. If you take railway logistics, we have deficit. If you look at the port, we have deficit. So road, no need to mention. There was a large amount of the expressways and all got built in the last 10 years. But otherwise, 10 years back, these were all something which were beyond India's ability. So in that period, infrastructure issues were much higher, and therefore infra story was very, very strong at that point of time. But as we move last 10 years, I think road construction has taken a big leap, in our opinion. Port capacity is not an issue. Most of the ports are today operating at a lower utilization at this point of time. There is a constraint on the railway logistics connecting to the port, which is also getting addressed by DFC. Most of the large, I'm not talking about here and there small infrastructure issues. By and large, a large part of the deficit in infrastructure from at least next 1 to 2 year, 3 year point of view is not a major concern. Therefore, the government spending will try to keep our infrastructure availability from next 4 to 5 year time period, and that's a right approach in our opinion. That is what on the overall side. But on coming to the company level, we always have difficulty with infrastructure because the kind of ROC that was made in this business was too low, and it had no margin of safety left. So you obviously play infrastructure only when there is a large push for spending, and that happened for a very short period of time. But after that, again, it was a false start. So if you take last 10 years, every time when infrastructure looked promising, it followed by 2-3 years of period where it did not meet the expectation of the investors. Today, given some bit of push in the PLI scheme and all these manufacturing companies are announcing, we feel that there will be some capex, so that will help certain specific companies. Can you play on an overall macro level and then play infrastructure? I think I don't think there is such a big opportunity in front of us. So in the past, in 2004, 2008, when it was deficit, power sector alone used to spend more than 5 lakh crores of money. And you had steel sector also investing at the same point of time, metals particularly. So the capex used to be huge. Today, power sector will add some capacity, but it is predominantly in the renewable energy, right? It is not massive capacities in coal and all this stuff. And transmission capacity power grid alone used to spend every year almost 50-60,000 crore in those periods. Right now, power grid is not even spending, I think last year number, if I look at, it is not even spending 3,000, 4,000 crore. I don't think it crossed even 10,000 crore in our opinion. So it's been there for a long period of time. So the bulk investors in the market, when it comes to private capex, that sector is not there yet. It is all happening by small companies like auto sector or FMCG sector or any capital goods guy. They are announcing capacity additions at this point of time. These are all, say, 4,000 crore, 5,000 crore over next 3-year period, 4-year period. Aggregate of it does not make a big number in our opinion. There are these large guys who have announced a green hydrogen project and all those stuff, but these will sometimes, I'll be worried if any banks take exposure in these, because then you have worry, what is the payback period? What is the payments mechanism? So people rewarded a lot of banks when they lend to power sector, and they paid the price of it in the next 4 or 5 year time period. So you have to lend, but you also have to know whether these projects will pay the money back to you and what is the guarantee for that. So to that extent, I think infrastructure, banking together, when you see, you play, infrastructure is a patchy sort of a business, and you need to be really careful because you don't make too much. The businesses don't make too much money. Therefore, you have to be lucky to make money out of it. On the other side, banks, you have to be careful that you don't expose to wholesale lenders who lend probably without adequate risk mitigation. And as we are going to go through a very tight liquidity period in globally as well as in India. I think a lot of fraud which was there will get removed, and more so you have to be very careful on what kind of lending practices the banks do, because it is easier to get carried away with this India growth story and then suddenly get caught into the situation that growth is not as high as what we envisaged, and then sit with a large NPA book. So we will have to be very careful in the next 1 year.
Okay. Thank you. Thank you. It was a very brief answer, I must say that. And jumping on to the last question for the session. So, what will be the 3 good qualities that you would suggest for an aspiring fund manager?
Quality for a fund manager, you're asking?
Yeah. For an aspiring fund manager.
Aspiring fund manager, I think be analyst first of all. I think you will never be a successful fund manager unless you get your act as an analyst very strong. You have to have capability of visualizing whatever you read and put them into numbers, and that requires a bit of an ability to understand different revenue models, cost models. That comes with experience only. So do your numbers. That is very important. I think even if when you become fund manager, just making your investments based on an analyst recommendation is not right. Analyst is there for you to help you, but it's very important that you also behave like an analyst and do the numbers along with the analyst, cross-check your assumptions. Even then you will make mistake, but you will reduce the number of mistakes significantly. And because a fund manager looks at the future to invest, right? Whatever he does on the numbers, it can go completely the other way also. But through that approach, he knows what he's buying, and therefore he will have a reasonable amount of certainty on where the earnings are getting into for majority of the stocks, if not for all the stocks. So that will give the fund manager a hold on the portfolio that he is investing. Second, read a lot on what is happening globally in the sectors that you are investing into, how those sectors matured globally, how those sectors grew, in what period they grew, what were the leading indicators of growth happening in those sectors, and also in sectors that you invest today in India, what are the similar companies globally are doing at this point of time, because you're investing for long term. If with the lag, sometimes India will also catch up with these global trends, and when you get opportunity to play those global trends at a reasonable valuation, not many a time you get the opportunity, but slowly it is starting to emerge. You can identify a completely unrelated. So, for example, you will not get a chance to play electric vehicle in India, but there could be one supplier in India who is supplying to electric vehicle operators globally. If you read what is happening to electric vehicle markets globally and have an idea and then put it in numbers, not just only assuming that electric vehicle will only grow. Everybody knows electric vehicle will grow, right? Which country it is growing, who is growing, which it is unrelated to Indian equity markets. Whether Tesla is growing or is it the traditional OEMs who are growing, it is unrelated. But you have to know that, you have to know who is growing. Only then you will be able to pick a stock in India who is a supplier to those companies and be able to put it. So that is why I insist that when you read as much as in India, you also have to take time to read about the sectors and the companies, what they're doing globally also, so that you will identify new emerging opportunities. Once it is identified, everybody will throw a price to those stocks. So it is the capability of the fund manager and the analyst to identify those ideas ahead of the market. And that comes only if you read and learn things beyond what the peers are doing. And peers are all looking at what is happening in India tomorrow, next quarter, what is going to happen. Particularly if you are a benchmark oriented investor, you mostly stick to the stocks in the benchmark and look at which are the ones who have to pick it up. That's the luxury that an independent fund manager who is not benchmark, who is not stuck to benchmark gets it. So he can look at things completely absolute and search for ideas which can come from anywhere. And to that extent, your ability to search for new ideas, that comes only by reading more than what your typical other fund managers are going to read. And that, in my opinion, I think a lot of dope comes from international, particularly US and China, what these businesses. So when I used to track capital goods, I take time to speak to people in Europe, because Europe was a great market for capital goods. A lot of great businesses. And even today we have ABB Siemens, which have come from Europe, right? So they had a technology advantage. So what these businesses think about them, and that helped me to be negative on this company for a very long period. Last 2 years has been good for these companies. But there was a period where I understood at a point that technology is becoming commoditized, and China is able to catch up with the technology much, much faster. So it set the stage for me that whatever you try and do, China is going to beat you in your home turf. So reading global of the trends that are happening in each sector can be really helpful in our opinion. I think these two, if you do most of the time, I don't need to tell you that you have to read everyday news and then analyze it. Those are all everybody has to do. Every fund manager has to do. But what you can do beyond that is, if you are owning a stock, analyst should own a stock like a fund manager, and a fund manager should research a stock like an analyst. This is the best pair, in my opinion. That's how a team will always work well.
Okay, so with that, we have come to the end of the session. So it was a very brief one. I must say the investor would, get a lot of ideas, while seeing this. Thank you for being on board.
Thank you so much. Thank you, Akshara. Thanks, PMS Bazaar, to host us. Thanks.